Hello friends, today we are diving into Basu 1977, the paper that gave the value premium its first rigorous test. The question is simple. Do cheap stocks, measured by a low price-to-earnings ratio, beat expensive ones by more than their risk can justify? If they do, the semi-strong efficient market hypothesis has a problem. And here is what makes this notebook different. We are not copying his tables. We download real CRSP-based portfolio returns from Kenneth French's data library, rebuild his quintiles, and re-estimate everything ourselves. Then we ask the question Basu could not. Did the anomaly survive publication? We use our standard scientific Python stack, plus URLs and GPIO to pull the data straight from Dartmouth. 2 downloads. First, portfolios formed on earnings to price, monthly returns going back to 1951. Second, the Pharma French factor file, which gives us the market access return and the risk-free rate we need for the CAPM regressions. The parsing helper handles Ken French's format, a text header, then year-month rows with minus 99.99 as the missing data code. We convert percentages to decimals on the way in. 75 years of real returns in about 30 lines. Now we map the data onto Basu's design. French sorts on earnings to price. Basu sorted on price to earnings. Those are reciprocals, so the quintiles line up in reverse. French's low 20, the lowest EP, is Basu's portfolio A, the expensive one. His high 20 is Basu's E, the cheap one. There is also a separate bucket for firms with negative earnings, which is precisely the group Basu had to fold into his most expensive portfolio. Now the differences, stated plainly. French forms portfolios in June on NYSE breakpoints and includes Amex and Nasdaq. Basu used April, NYSE industrials only. So expect the pattern to match and the decimals not to. Here is the first look at real data. 14 years, 168 months, exactly matching the paper. The chart tracks a dollar invested in each quintile from April 1957. And the ordering is already visible. The cheap quintile, in green, pulls steadily away from the pack. The expensive quintile, in red, lags the market for most of the period. A dollar in cheap stocks becomes $8.85. The same dollar in expensive stocks reaches only $3.11. Nobody has adjusted for risk yet. That comes next. But the raw pattern Basu described is right there in the data. So we have two hypotheses in direct conflict. The efficient market hypothesis says prices already reflect all public information. PE ratios are public. So sorting on them should tell you nothing that risk does not already explain. The price ratio hypothesis says the opposite. Investors extrapolate, so optimism inflates glamour multiples and pessimism deflates dull ones. Prices are biased and PE marks the bias. Basu's design keeps the test honest in one crucial way. He waits 3 months after the fiscal year end before buying, because that is when the filings are actually public. French's June formation date builds in the same protection. And here is the result computed from scratch. The left panel shows average annual returns rising as we move from expensive to cheap. 9.3% for the priciest quintile, 16.8% for the cheapest. A spread of 7.5 points. The middle panel is the one that matters. If this were risk compensation, beta should climb alongside the returns. It does not. The cheap quintile carries a beta of 1.04 against 1.08 for the expensive one. Slightly lower risk, dramatically higher return. And the Sharpe ratios on the right more than double across the sort. A raw return gap proves nothing by itself. You have to price the risk. The market model says a portfolio's excess return equals alpha plus beta times the market excess return plus an error term. Three measures follow from it. Jensen's alpha is the intercept, mean portfolio return minus beta times the market return. That is, excess return beyond cap M. Trainer divides excess return by beta, giving reward per unit of systematic risk. Sharpe divides by total standard deviation instead. Under the efficient market hypothesis, every alpha should be zero. Deviations should be noise, and noise should not line up in a straight row. The alphas line up exactly as the price ratio hypothesis predicts. The cheap quintile earns 6.2% a year above what CAPM says it should. The expensive quintile earns 1.6% below. That is a spread of nearly 8 percentage points of pure risk-adjusted return from a sort anyone could compute. On the right, the T statistics against the 5% critical value. The two cheap quintiles, D and E, clear it comfortably. The expensive N is negative but weaker. So the strong evidence sits on the cheap side, which is a slightly different emphasis from the paper and worth being precise about. This is the replication scorecard, and it holds up well. Our returns track his almost exactly at the extremes, 9.3% for the expensive quintile against his 9.3, and 16.8 for the cheap one against his 16.3. The correlation across quintiles is very high. Betas sit slightly below his throughout, which is what you would expect from a different universe and a value-weighted scheme. Our alphas run a little larger at the cheap end. Different data vendor, different formation month, different weighting, and the same conclusion. That is what a robust finding looks like. And now the payoff for using live data instead of a printed table. We can look at what happened next. An anomaly found inside a sample is always suspect. It might be genuine mispricing, or it might be the residue of 1,000 researchers testing 1,000 sorts on the same 168 months. The honest test is out of sample, and publication is the sharpest experiment there is. If the effect was real and exploitable, arbitrage capital should have arrived after 1977 and competed it away. So let us split the record. Basu's window, everything after it, and the full 75 years. The gradient is visible in all three eras, but it flattens. In Basu's window, the cheap minus expensive return spread was 7.5% a year. After publication, it falls to about 3.3. The alpha spread follows the same path. So the effect did not vanish, and it did not stay put either. It roughly halved. That is exactly the signature you would expect if a real mispricing gets partially arbitraged once it is published and capital shows up. Notice that portfolio E's alpha stays statistically significant even after 75 years. Weaker, still there. And this is the chart that complicates the story. Decade by decade, The cheap minus expensive spread is nowhere near constant. It was enormous through the 50s, 60s, and 70s, 7 to 10% a year. It shrank through the 80s, then it went negative in the 1990s, roared back in the 2000s, and has been negative again through the 2010s and 2020s. The rolling 10-year panel on the right makes the swings obvious. So the honest summary is not that value investing works. It is that value investing worked spectacularly in Basu's sample and has been unreliable since. And now the part almost everybody forgets. A statistically significant alpha is not a trading strategy. So Basu charges it for everything a real investor would pay. Actual NYSE commissions from the exchange's own fact books, 0.25% a year for search and information processing, and taxes at 25% on capital gains and 50% on dividends. Then he splits investors 4 ways along 2 dimensions: taxed or not, and reallocator or trader. That second distinction is the crux. A reallocator was going to trade anyway, so only the incremental cost counts. A trader buys the anomaly on purpose and pays full freight. Watch the anomaly decay from left to right. A tax-exempt reallocator captures 3.1% a year and beats every one of the 10 random portfolios at the 5% level. Add taxes and it drops to 2.3%, still significant in 9 of the 10. But now, switch to a trader, someone buying the anomaly deliberately. 2% and significance falls to 4 of 10. And a tax-paying trader? Under 1% a year, with just 1 of 10 comparisons reaching significance. Same signal, same data, completely different conclusion depending on who you are. This chart is not in the paper, it is the question the paper provokes. If costs are roughly what Basu measured, how much of the gross premium actually survives in each era? In his own window, with a 7.5% spread, even the worst-case tax-paying trader keeps about 70% of it. But apply those same costs to the post-publication era, where the spread is only 3.3% and the trader keeps under a third. The heat map on the right shows the squeeze. As the edge shrinks, the fraction lost to fixed costs grows. That is how anomalies die in practice. Not by vanishing, but by falling below the cost floor. And here is the whole record on a log scale. $1 in the cheapest quintile in 1951 becomes roughly $49,000 by 2026. The same dollar in the most expensive quintile reaches about 1,300. That is a ratio near 38 to 1 from one sorting variable. But look at the shape after the dashed line marking publication. The green and red curves run much closer to parallel than they did before. The gap is still widening, just far more slowly. Most of that spectacular ratio was earned in the first half of the sample. So what did we find? Working from real returns rather than his printed tables, the PE sort delivers a 7.5% annual spread in Basu's window, very close to his own 7. It is not explained by market risk because the cheap quintiles carry lower betas. The alpha is significant at the cheap end. It survived publication, but roughly halved. And it is badly unreliable decade to decade, negative through the 90s, the 2010s, and the 2020s. Basu's own conclusion was careful. The anomaly is real, the free lunch is not. Thank you for watching, and I will see you in the next paper breakdown.